Chapter 4 discusses the income statement, comprehensive income, and the statement of cash flows. It focuses on three basic items within the chapter. First, it considers issues dealing with content and presentation for the income statement as well as comprehensive income. It then introduces us to the statement of cash flows, and ultimately, it will also provide us with common ratios that we can use to analyze profitability. The income statement reports a company's profit during a given period. We calculate this by taking revenues plus gains and subtracting out expenses and losses. And this produces for us profit or net income. This shows how a company's operations have performed in a given period. There's some gains and losses that are excluded from income statement but included in the concept of comprehensive income. And we'll talk about as the chapter progresses what specifically those gains and losses are. We often refer to this as direct to equity adjustments. And as I mentioned in previous chapters, this concept of other comprehensive income, or often it's referred to as OCI, is going to close into the equivalent of retained earnings for OCI, which is AOCI, accumulated other comprehensive income. But again, we'll talk about this a little bit later on in the chapter. The statement of cash flows tells us information about cash receipts and cash payments that happen during a particular period. Remember, the income statement is on an accrual basis, so in order to provide the financial statement users with cash basis information as well, we provide the statement of cash flows. Remember that the difference between the receipts and the cash payments during the period produces for us the change in cash. And to help financial statement users better understand how cash flows in and out, what the sources and uses are, so to speak, of the cash, we have split the statement of cash flows into three different sections. We have the operating section, the investing section, and the financing section. When preparing the statement of cash flows, we can associate each one of these sections with various other components of financial statements. For instance, the operating section will be associated with net income and then also current assets and current liabilities from the balance sheet. Remember, when we prepare the operating section on the indirect method, we start with net income and then adjust for changes in current assets and current liabilities. So that section can be associated with other financial statements in your analysis. The investing section is often associated with non-current assets, and the financing section is typically associated with non-current liabilities as well as some components of stockholders' equity. We'll talk about in detail in future parts of the chapter exactly how we prepare the statement of cash flows, or at least an introduction to how we prepare it. But the chapter starts our focus in these three areas with the income statement and has us consider some presentation and content considerations that perhaps weren't addressed as in depth in your introductory course. So we start by considering the income statement. Here we have an example of a multi-step income statement. Let's highlight a few items as we're looking at this income statement. First of all, notice the header. We have a header here just like we do with any other financial statement. We're showing comparative years. This is common in financial statements to not just show 1 year, but to show 2 or 3 years depending on the financial statement that you're looking at. Notice they tell us that we have a year end of December 31st. This implies that we have a calendar year end. This is not to say the company couldn't have a physical year end instead. A physical year end is where we have a date that ends other than December 31st, representing the end of the year. So for instance, June 30th. If we had a physical year end of June 30th, that would imply that the annual report would show a year leading up to June 30th to represent the year of operations. There's a few components shown on this multi-step income statement that are worth highlighting before moving on, as they foreshadow what it is that we're about to talk about. At the top here, you can see income from continuing operations. This is the income portion of the financial statement that we expect to see in the future as well. Again, continuing operations, which we can contrast from discontinued operations. You're going to hear some concepts talk about permanent earnings versus temporary earnings. There's another component that's useful in highlighting, which is operating income here. This is different than continuing operations. This operating income subtotal highlights the idea that everything above here is from core operations, where information down here from non operating activities includes peripheral or incidental transactions that are not part of core operations. We also have the component of income tax expense, and we've got income before taxes, as well as income from continuing operations before we highlight discontinued operations as well. And finally, you have the overall total of net income that we've talked about in previous courses. At the very bottom here, you see ratios included on an income statement. These are the only ratios. Earnings per share is the only ratio actually required to be on the face of the financial statements. And as we get through later on in the chapter, I'm going to show you how to calculate that. But the basic idea is we take net income minus preferred stock dividends and divide by the weighted average number of common shares outstanding. Again, we'll go through this calculation. Notice that we have both a diluted calculation and a basic calculation. In this chapter, we're going to talk about the basic earnings per share calculation. In future chapters, we'll also talk about the diluted earnings per share calculation. Again, as we progress, we're going to highlight some of these components in detail. To ensure you understand what the income statement is showing you, let's talk about two of their major components, revenues and expenses. Revenues are defined as inflows of resources resulting from providing goods and services to customers. Expenses are outflows of resources incurred while generating revenue. Oftentimes, we try to establish a causal relationship between expenses and revenues, meaning that we take on expenses in order to produce revenues. Again, that's why we refer to them as the cost of providing our goods and our services. Remember that the income statement is showing information during the reporting period. In other words, it has a start and an end date. Remember, we often classify in the header through a period of time. This is different than what we show on the balance sheet, which is at or as of a certain date. As I mentioned, we often try to establish a causal relationship with expenses and revenues. We say that expenses are taken on in order to generate revenues. If we can establish that causal relationship, then we will recognize the expenses in the same period that revenue is recognized. An example of this would be cost of goods sold. However, if we cannot recognize a causal relationship, then we may recognize the expense in a particular period, like rent expense, may be allocated over several periods like depreciation expense, or recognize it as we incur the cost or get that benefit, like for instance, advertising expense. Gains and losses are increases or decreases in equity. Losses would be decreases, gains would be increases in equity from peripheral or incidental transactions. They're treated very similar to revenues and expenses, but revenues and expenses are from core operations. Gains and losses are from peripheral or incidental operations. An example of this would be the sale of equipment, buildings, or other operating assets for amounts that are different than the recorded amount, meaning that there's a difference between what they sell for, their sale price, and their book value. That difference produces for us a gain or loss. Obviously, if the sale price is more than the book value, you have a gain, and if it's less, then you have a loss. These items can all be shown in our income from continuing operations. And while it's true that some gains and losses also can be shown in discontinued operations, they can be shown in continuing operations as well. In determining whether or not they would be included in continuing operations or discontinued operations, you have to consider what the nature is of the item that you're considering. For instance, is it a gain or loss on the sale of a segment of business that is no longer being operated? Well, then it would be discontinued operations. Future portions of this chapter, we're going to talk about this idea of earnings quality, which allows us a framework to consider why we break up the income statement the way we do. For instance, we enhance earnings quality, or the ability for us to predict future cash flows, by separating activities on the income statement from operating activities and non-operating items. This tells the financial statement user, here is our core operations of business, and here is our incidental or peripheral operations of business, right? We can also split our information on the income statement up into income from continuing operations, and later on we'll see discontinued operations as well. This also helps us determine what we might consider to be permanent activities, those activities that we can expect in the future, or at least to impact income in the same way in the future, and those that we expect to be temporary. Notice our subtotals again that we highlighted earlier. We have operating income. This allows a financial statement user to compare year over year how core operations are doing. We also have income from continuing operations before income taxes here and here. This allows a financial statement user to compare entities in different tax jurisdictions, for instance, different income tax rates that they might be facing depending on where they're doing business, or compare entities that are taxable entities like corporations to non-taxable entities, or at least flow-through entities like partnerships or sole proprietorships. And then you also have income from continuing operations. This allows a financial statement user to compare how a company is doing year over year from its operations that are expected to continue versus those that later on that we see are temporary or discontinued. This way you get the information of that's all inclusive of discontinued operations, but you still get to see the comparison for predictive value, earnings quality, for predictive value in the future of what we expect is actually going to continue. Interestingly, there's actually no specific standard that dictates how income from continuing operations has to be displayed. And so companies actually use various formats that you might see in practice. But in general, we can group them into two main ones. We have the single step income statement, and then here in a moment, I'll show you the multi-step income statement. With the single step income statement, we group all the revenues and gains together first. So those are shown in this section right here for a fictitious company. And then we group all the expenses and losses, with the one caveat that income tax expense is always shown separately, as you can see here. And this produces for us income before income taxes by separating out income tax. And again, this allows us to compare entities from different tax jurisdictions and or entities that are taxable versus non-taxable or flow-through entities. The main thing to note with a single step income statement is this idea that it's one step. We report revenues, we report expenses, and if you were to just sort of put aside that idea of income tax expense, this produces net income. So it's the single step, and that's where it gets its name. Multi-step income statement, as its name implies, has a series of steps or subtotals that provide the financial statement user with further information. For instance, gross profit, which is the markup above the cost of goods sold. We've got operating income, which tells individuals, financial statement users, how core operations is doing. We also have our incidental transactions over here, and we have our amount of income before income taxes, just like we do with the single step income statement, and ultimately net income. One thing to note is that the ultimate result, this net income figure, is not going to differ between the format of the financial statements. It's still going to be the same. It's just how we get there is going to be slightly different. But by providing these intermediate subtotals, we definitely provide the financial statement user with further information that they're able to better analyze a company with. We now should have enough information to do our first practice problem, so you can go on to the next video and we'll try that.